The Forex market is generally focused on 8 main currencies from around the world, namely the US dollar, the euro, the British pound, the Swiss franc, the Japanese yen, the Australian, Canadian and the New Zealand dollar. Now when we trade Forex, we're trading 2 individual currencies at the same time. We're buying one currency and we're selling another currency against it. Now these 2 currencies, when matched together, are called pairs. If you cross-match the 8 main currencies against each other, we come up with a total of 28 different possible pairs to trade from. Now, recent studies showed that 83% of all currency trades in the Forex market has the US dollar on one side of the transaction. Consequently, the main currency pairs that are traded by FX traders today are the US dollar denominated pairs. Now, these are classified by the market as the majors, and the remainder of the 28 possible pairs are considered the minors. Now all the other possible pairs, such as the South African rand, the Chinese yuan, the Mexican peso and so forth, now these are considered the exotics. Now trading the majors has a significant advantage over trading the minors and the exotics in terms of cost. Now because the majors are much more actively traded, the spread, and that's the difference between the buying price and the selling price, is often much tighter, so the cost of trading is far cheaper. Now that same study showed that the Euro USD, that's the US dollar, is the most actively traded Forex pair of them all and accounts for 30% of all Forex trades. Therefore the spread on the Euro USD is much tighter and the cost of trading this pair is normally much cheaper.